History's most destructive financial bubble wasn't built on stocks or bonds. It was built on a flower. And in 1637, the Dutch perfected a blueprint for collapse so precise, every market crash since has been its echo. We believe stock market crashes are modern phenomena, born from computers and derivatives. But 4 centuries ago, the Dutch created the architecture of speculative collapse with such precision that every bubble since has followed their formula stroke for stroke. This is not a story about tulips. This is a dissection of Windhandel, the Dutch word for trading wind. Trading nothing. Trading promises on top of promises until the entire structure collapses into the void it was built upon. The pattern has a name. It has stages. And it has a final phase that most investors never see coming. This video decodes the VOC bubble, reveals why the 1636 plague accelerated the mania instead of stopping it, and extracts the survival lessons that separated those who walked away whole from those who were destroyed. History doesn't repeat, but if you ignore its blueprints, the collapse will feel like the first time, and by then, it's too late. In 1602, the Dutch East India Company, the VOC, did something no commercial enterprise had ever attempted. It sold shares to the public. Not shares in a single voyage. Not shares in a temporary partnership. Permanent, transferable ownership in a corporation designed to outlive its founders. The innovation was elegant. The consequences were unforeseen. Within a decade, Amsterdam's stock exchange became a theater of speculation unlike anything the world had seen. Merchants no longer invested in ships. They invested in the idea of ships, in projected profits, in rumors of Indonesian spice routes and Japanese silver mines. The VOC's stock price began to move independent of its actual performance, driven instead by narrative, rumor, and the intoxicating belief that wealth could be conjured from cleverness alone. This was the birth of Windhandel, wind trade. The Dutch had a word for it because they had mastered it. Contracts were signed for goods that did not exist. Options were sold on shares not yet issued. Tulip bulbs, initially a luxury commodity, became the perfect instrument for this new alchemy because their value was entirely psychological. The mechanism was invisible but lethal. When you trade a ship, the ship exists. When you trade a future harvest, the soil exists. But when you trade contracts on contracts on contracts, the entire structure floats on belief. And belief, unlike gold, evaporates the instant doubt enters the room. The Seleucid Empire learned this in 100 BC, when silver shortages exposed that much of its currency had been debased with base metals. The empire had been trading on the appearance of wealth, while the substance quietly dissolved. When citizens discovered the fraud, the currency collapsed in weeks, and with it, the empire's ability to pay soldiers, collect taxes, or enforce order. The Dutch were repeating the pattern, but this time the fraud was not in the metal, it was in the system itself. By 1636, the entire market was unmoored from reality, a structure built not on assets, but on pure momentum. The question was not if it would sink, but when, and who would still be aboard when the air ran out. In October 1636, bubonic plague swept through the Netherlands, killing 1 in 7 citizens in Amsterdam alone, erasing entire family lines in a single season. Economic logic suggested the bubble would burst. Death destroys commerce. Fear destroys speculation. Instead, the mania accelerated. The reason was hidden in inheritance law. When speculators died, their wealth, land, cash, contracts transferred to surviving family members who had never participated in the market. Suddenly, Amsterdam was flooded with newly liquid capital in the hands of people who did not understand the risks they were inheriting. Taverns became trading floors. Blacksmiths, weavers, and servants entered the tulip market, believing they were late to a guaranteed fortune. Contracts for single bulbs sold for the price of a canal house, not because the flower had changed, but because the crowd had convinced itself that scarcity plus demand equals infinite value. The government, rather than intervening, deregulated. Calls for oversight were dismissed as a tax on prosperity. The market, the government assured itself, would find its own equilibrium. Mexico's Tequila Crisis in 1994 followed the same script. Deregulation flooded the economy with foreign capital chasing pesos and government bonds. The narrative was unstoppable growth. The reality was a currency pegged to belief, not reserves. When the peso collapsed in December 1994, the economy seized within 72 hours. Fortunes built on leverage evaporated before their owners could react. By early 1637, Dutch tulip contracts were being sold by people who did not own bulbs to people who could not afford them, with settlement dates in a future no one had planned for. The entire market had become a chain of promises, each link depending on the next. But a chain built on belief has a fatal weakness. It only needs to break in one place, and all it took was a moment of silence. On February 3, 1637, a routine tulip auction in Haarlem failed to attract a single bid. The silence lasted only seconds, but it was enough. By nightfall, the news had spread across the provinces. The wind had stopped blowing. The collapse of the tulip market was not a crash. It was an evaporation. Prices did not fall gradually. They vanished. Contracts written for thousands of guilders became worthless overnight because no one would honor them, and no court would enforce them. The Dutch had built a market on a foundation of air. When the air disappeared, there was nothing left to stand on. Across 4 centuries, the instruments change. Tulips become railroads. Railroads become mortgage bonds. Mortgage bonds become cryptocurrencies. But the architecture of collapse remains identical. First, a legitimate innovation creates real value. The VOC's global trade network was genuine. Then speculation decouples price from value. Then leverage amplifies the decoupling. Then new capital, often from those least equipped to evaluate risk, floods in at the peak. Finally, a single moment of doubt triggers simultaneous realization. Everyone was trading wind. Venezuela's petro-state collapse in the 2010s demonstrated the same invisible mechanism. Oil wealth created the illusion of permanence. The government spent future revenue as if it were present cash. When oil prices collapsed, the entire economic structure, built on the assumption of perpetual high prices, evaporated. Citizens holding bolivars watched their savings become worthless in months, not because the currency was attacked, but because it had always been backed by belief, not reserves. Modern markets exhibit the same warning signs the Dutch ignored. Asset prices rising independent of productivity. Debt levels that require perpetual growth to service. New investors entering not to build wealth, but to avoid missing out. Regulatory capture disguised as innovation-friendly policy. The most dangerous phase is not the mania. It is the moment just before the silence. The moment when prices are highest, confidence is universal, and the first person who refuses to buy is dismissed as ignorant. That moment is when the air is thinnest, and the fall is steepest. As in Amsterdam, as in the Seleucid Empire, as in Caracas, when money loses its anchor to reality, people instinctively seek assets no government can debase and no narrative can inflate. Hard assets, custody, control. Not because they promise returns, but because they exist beyond the reach of collective delusion. When the market evaporated, 2 groups emerged from the wreckage. Their fates were opposites. The first were the victims. They had used leverage, signing contracts for bulbs they could not afford, expecting prices to rise forever. When the music stopped, they owed debts they could never repay. Their homes were seized, their businesses liquidated, families destroyed. The second group were the survivors. They remained liquid and debt-free. They watched the mania from the outside, holding cash. When prices collapsed, they bought real assets, land, buildings, inventory, for fractions of their former cost. They didn't get rich during the bubble. They got rich after it popped. The Mexican Tequila Crisis revealed the same division. Those holding dollar-denominated debt were obliterated when the peso devalued 50% overnight. Those holding physical assets or foreign currency reserves survived and acquired distressed properties for pennies. History's lesson is not complex. In speculative manias, the winner is whoever exits before the crowd realizes there is no exit. The Dutch survivors understood three principles. First, liquidity is survival. When markets freeze, only cash and universally accepted assets retain value. Second, debt transforms wins into losses. Leverage works in both directions, and the down direction moves faster. Third, custody defeats counterparty risk. A tulip bulb in your hand is worth more than 10 contracts promising future delivery from a seller who may not exist tomorrow. Modern application requires translating these principles into contemporary instruments. Liquidity means holding reserves outside the banking system. Debt avoidance means rejecting the cultural narrative that leverage is sophisticated. Custody means controlling your own assets, whether land, commodities, or algorithmic scarcity that answers to mathematics, not ministers. The pattern teaches one final, uncomfortable truth. The majority will always be on the wrong side of the trade. By definition, bubbles require widespread participation. If everyone avoided them, they would never inflate. The survivor's advantage is not intelligence. It is the willingness to be called ignorant while the mania rages, and vindicated only after the destruction is complete. The Dutch Tulip Mania was not an anomaly. It was a prototype. Every element that defined the VOC bubble exists in modern markets. Assets priced on narrative rather than cash flow, leverage disguised as innovation, regulatory approval mistaken for safety, and new capital flooding in just as the structure becomes most fragile. The invisible mechanism remains unchanged. Windhandel, trading air, requires only two conditions: an asset whose value is subjective, and a crowd willing to believe that this time is different. Once those conditions align, the outcome is mechanical. The mania escalates until a single moment of doubt triggers universal realization. Then the air vanishes, and everyone still aboard discovers they were trading nothing all along. The 1636 plague did not stop the bubble. It accelerated it by flooding the market with inherited wealth in the hands of those least equipped to recognize the danger. Today's equivalent is not disease, but monetary expansion. Trillions in liquidity seeking returns in an environment where safe yields have been engineered to zero. The Dutch who survived were not smarter. They were positioned differently. They held liquidity when others held promises. They owned assets when others owned contracts. They maintained custody when others relied on counterparties who would vanish the moment trust evaporated. The Seleucid Empire collapsed because it traded on the appearance of wealth while the substance dissolved. Mexico's economy seized because it pegged its currency to belief, not reserves. Venezuela imploded because it spent the future as if it were the present. The Dutch discovered that markets built on air cannot stand once the wind stops blowing. The pattern is not a prediction. It is a law. When speculation decouples from value, when leverage amplifies delusion, when new capital arrives at the peak, the outcome is predetermined. Only the timing is unknown. History doesn't repeat, but if you ignore it, it will crush you all the same. The answers are in the past. The warning is in the present. The choice is yours. If this analysis opened your perspective, subscribe to the Financial Archive to decode other patterns before they repeat. The next bubble will follow the same blueprint. The only question is whether you will recognize it before the silence falls.